All right, students, this is the last lecture of the year right here. So our final lecture will look like this. I'm calling it 13 Part B, so make sure you don't confuse it. If you've watched Part 13, the first part, this is separate and it's got the audio to go with the last several slides. Okay. Um, First of all, we're going to cover the final financial ratios we want to cover for Chapter 13, and then we'll go into a very valuable tool that's simply called financial statement analysis. We'll look at some horizontal analysis, vertical analysis, and then combining those two into a common size analysis. And always important to students. Many students want to know what's on the final exam, so I've got a checklist I'll go over with you briefly there. Okay, final ratios. Several performance ratios that we haven't covered yet are very important to the performance of the company. One is profit margin. This is not to be confused with the gross margin, which is simply your net sales minus your cost of goods sold. Profit margin is actually considered return on sales, or the return to sales, where you take your earnings and compare them to sales revenue. So your profit margin is really your net income divided by net sales, and then it is expressed as a percentage. Okay, so if a company had, 100 million in net sales and they profited, say, 5 million net income at the end of the day, that'd be 5% would be their profit margin. And that's pretty important because you think for every dollar of sales, then there's going to be 1 nickel of profit, or 5%, 5 cents on the dollar. So those are pretty big, pretty important numbers. Okay, some industries have a very fat margin, and that's where this number would be higher, maybe 10, 25%. But most companies have a very slight margin, but they have huge volume. So important for you to know what the profit margin is and how it is distinguished from gross margin, which you may have talked about in Business 1. All right, earnings per share, we already covered that, so I don't need to go over that again. Return on equity is one we haven't covered, known as ROE. Obvious reasons that's what it stands for. Shows profit per dollar invested. So if you're a shareholder and the company needed to raise new capital, you would probably prefer that they do it through bonds. If you were bullish, or that means very hopeful or very optimistic about the company's future, you would prefer that they issue bonds instead of new equity, because if equity goes up, the bottom of the fraction goes up and your return on equity goes down. In other words, they're spreading out the ownership amongst a greater number of shareholders, and so your ownership is diluted unless you buy a proportional percentage of what you already own. So if you're a bond holder, right, you'd have a different perspective. But return on equity is a really important profitability measure because the shareholders want to know what's the return on my share of equity. Okay, so there's an important one. You just look at net income divided by total shareholders' equity, which is included in most balance sheets, in all balance sheets, sorry. Asset turnover is a very important one that also tells how efficiently a company is utilizing its asset base. So if you're a business major and you come out of college and you want to go analyze a company, they might ask you, well, what can we do better? Well, you want to look at asset turnover because you want to see how much revenue you're generating for the asset base that you have. A lot of really big companies have tremendous assets in the way of profit. I'm sorry, in the way of products, in the way of inventory, in the way of their plant assets, in the way of property, in the way of company capital, human capital, and the number of people they have on the payroll. So there's a ton of assets there. The company wants to really look at how much revenue are you producing for your asset base. Okay, so it's simply net sales divided by total assets. This is typically, and that's going to be in dollars, it's going to be in dollars, so this is going to be a turnover ratio. It's going to be a number again. And so what happens here is the asset turnover ratio tells you how efficiently you are generating sales dollars for your asset base. Okay, final segment of the year. I know I keep saying that, but it's true. First of all, we're going to look at financial statements and a very, very high level view. And why would you do this? Well, first of all, you want to see if there's any accounting irregularities. Never a good term for a company. You want to track business trends for the company and its markets. You'd want to compare that to its competitors. And you would want to decide whether or not you're going to invest or get money out of this company if you're already invested. If you were a lender or a big bank or any other lending institution, you want to know whether to loan money to the company or not. You would have a very similar perspective on this if you're a potential investor as a bondholder, perhaps. Okay, and we didn't mention competitors here, but clearly you'd want to look at this just compared to business trends overall for that business segment. You'd also want to look at the trends for their competitors and see how they're doing compared to them. So financial ratios are simply the relationships between financial statement amounts. And what we mean by that is we're going to look at year-to-year performance Or actually, if you had the data, you would look at quarter to quarter performance. And every quarter is different, right? Right now, at the time we're doing this lecture, it's Christmas time. So you would not compare the quarter that includes Christmas for a retailer like a Nordstrom's or Macy's or somebody. You would not want to compare that to, say, the summertime. Okay, but you certainly would compare Q4 usually for these companies to the fourth quarter of a previous year and see how they did in similar quarters, is how they would phrase that. You're going to look at how they are performing independently, and of course, you're going to also look at how they compare to their competition. All right. How we do this is we look at the previous accounting period as the base for our comparison. In other words, we would subtract, say, 2010 from 2011 numbers, and you'd look at the difference. Then you'd look at the dollar difference. In other words, if in 2010 we made 100 million, in 2011 we made 110 million, then we'd subtract those two and get 10 million. That would be the increase or the decrease. Now it could go down, right? If we had 100 million in assets in 2010 and we only had 90 million in 2011, clearly there could be a decrease here. Once we have the difference in dollars, then we divide that into the base year, which is the oldest year in this comparison. You divide it by the base year, and then you get a percentage increase or decrease. Okay, the best way to describe this is to look at some balance sheets for companies. So here's a Makeup Corporation, Clover Corporation, and here we have 2010 and 11. All right, let's just look at their liabilities section for starters. We're not going to look at the assets. Liabilities went up by a significant amount. If you subtract 67 minus 44, you get a difference there of 23. Now, they don't show that here. Okay, but what they're doing is 23 divided by 44. Okay, you're getting a pretty big percent increase there. Actually, I'm going to skip this one and go to their go to the one they have in the book. If you look in your textbook on page 558, look at Exhibit 13.1. They're looking at research in motion. These are the people who do BlackBerries. Okay, and the data is fairly recent. And actually, since 2010, BlackBerry's really struggled, or research in motion has really struggled. But we're going to look at some good years here. Okay. Look at their cash balance. It went from 835,000, actually, and these are in thousands, that's 835 million to 1.55 billion from 09 to 2010. That's pretty good. So notice the difference here. They took 1551, I'm rounding here, minus 835, and they got 715,000, or in thousands, it's really millions. But anyway, that's the dollar difference that we talked about. Then they divide that difference into the base year, 2009. They divide 715 into 835, and that's almost 100%. Well, actually, it's 85.6%. So first you get the actual difference. Again, 1550 minus 835 gives us a difference of 715. You divide the 715 by 835, and you get 0.856, or as a percentage, you get 85.6%. They do that right down the line. You can look at their asset base. It was 8.1 billion. Now it's 10.2 billion. That's a difference of 2.1 billion here. You divide the 2.1 into the 8.1, and you're going to get 26% over a quarter, right? 25% would be a quarter. So they had a growth in assets of 26%. Wow, that's pretty good. That's a growing company. All right, let's look at their liabilities. They were 2.2 billion. Now they're 2.6 billion. Yeah, they went up. Okay. The difference here is 374 million. Now it says 374,000, but remember these are in thousands. Okay, so 374 million divided into 2.227 billion gives them only a 16.8% difference. So their assets went up by 26%. Their liabilities only went up by 17%. That's good. We like that. That means equity must have gone up. Look at the total equity down here. Second row from the bottom. It went from 5.87 billion to 7.60 billion. That's a difference of 1.73 billion. I'm looking right here with a little bit of rounding. 1.73 divided into 5.87. That's an increase of 29.4%. Okay, so think about it. Their total assets went up 26%. Of that 26%, this is how it was divided out. Now, these don't add up to 26. If you do the math, they don't have to. Don't think about that right now. It's not a math class. But the liabilities went up by 17%. Equity went up by 29%. That's awesome. This looks like a very well-run company. But what you can do is you can look right down the company and see how every line item changed. Well, what happened to receivables? Oh, they went up 22%, 23%. What happened to our short-term investments? Oh, those dropped. What happened? Well, we must have cashed out a whole bunch of these. We must have freed up some cash. Maybe that's why cash grew by 85%. Okay, so short-term investments, we dumped some of those, built up cash. Maybe we're going to buy another company. Maybe we're going to invest in something. You can look at your inventory. Inventory went down. That's good, right? If you're building inventory up, hopefully you're going to sell it, but you can look at inventory. You can look at your other current assets. You can look at your property, plant, and equipment. Those went up by 46%. Okay, you can look at all kinds of things. What happened to our income taxes payable? Oh, they dropped a whole bunch. They dropped by 74%. Okay, what happened to our liabilities? Well, they went up by 32%, but that's okay because our cash went up by 85%. We're still doing okay, all right? Stock, did stock go up? No, it went down slightly, not even enough to register, 0.0%. So we didn't issue or buy back stock. You can see that very clearly. Okay, treasury stock, oh, it looks like that went down by a certain amount. They don't list negatives here because there's anything divided by zero, you can't list it, okay? Mathematically, that's an undefined number. Anyway, retained earnings, oh, that went up a whole bunch, almost 50%. So you can look at a company pretty quickly and take a look at how this horizontal analysis or trend analysis, because you're looking at trends from year to year, you can look at how this works simply by, again, dividing or subtracting. Take the big number, subtract out the previous year, get the absolute dollar difference, divide that dollar difference into this one, and you get 0.856 or 85.6 as a percent. Very helpful for balance sheet. Now, here we are looking at the next page in your textbook, page 559, exhibit 13.2. Same thing goes for an income statement. This is even more telling, right? Look at what happened with the revenue. Went from 11 billion, again, these are all in thousands, went from 11 billion to almost 15 billion. Wow, that's a difference of 3.9 billion. That's great. Divide the 3.9 into 11.0 or 11.1, and you got a difference of 35%. That's awesome. 35% revenue growth, that's tremendous. Well, we know cell phones are taking off. Looks like Blackberries are taking off, so this is good for them. What about our cost of sales? Uh-oh. This went up from 5.97 to 8.37. That's a difference of 2.4 divided into this. And look, this is a very telling number. Our cost of sales went up by 40%. Our revenue only went up 35%. Oh, that's not good. We'd like this number to grow faster than our costs are. What this means is their margin is shrinking. Okay. All right. So gross profit went from this to this. This is dollars, not percentage again. Dollars here went 1.48 or 49. The gross profit actually went up by 29%. So we hope that's okay. That's still growing in terms of dollars, right? R&D, we invested 41% more in that this year. Selling, marketing, these costs went up by 29%. You can look very quickly and see the trends right down the line here. Okay, litigation, we spent a bunch of money on litigation that we didn't have any in 2009. That's not good. Okay, so that's over 100%, right? That'd be an infinite percent because there's no base year. Okay, income from operations, overall income went up 19%, not bad for revenue growth of 35. All right, what is our total income? Well, that went up by 30%, not bad. So revenues went up 35, net income went up by 30% as a percentage. That's pretty good. So this looks like a pretty good company. But what you can do is you can look at horizontal or trend analysis year over year and see how the company is doing. Right now, based on these numbers, you would say Research in Motion is doing pretty darn good. Now, if you look at 11 and how I think 2012 is going to turn out, I think you'd see a very different story because I know they've really struggled in 2011. Okay, but anyway, that's horizontal analysis right now. We'll come back to vertical analysis in a moment.